Corporate finance practice problem using Onenote. Land and 5-year MACRS depreciation, property, cash flow, and net present value. Get ready, it's time to take your chance with corporate finance. Here we are in Onenote. If you have access to Onenote, would like to follow along, you're not required to, but if would like to, we're in the icon left-hand side, Practice Problems tab, and then down in the 1240 Land and 5-year MACRS depreciation, cash flow, and net present value tab. Also note, when using Onenote, look at our immersive reader tool. The presentations up top will be mirrored down here in the text area with the same name, same number, having transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon up, information up top, calculation down below. This will be another more comprehensive type of problem where we're going to be taking into consideration some of the factors, some of the things that we've looked at in prior presentations. We're going to be thinking about an initial investment that's going down up front once again, and also thinking about the cash flows, cash benefits that we expect to receive in the future. As we look at these long-term projects, we are on a cash basis so that we can think about the present value of the cash flow. That's going to be our strategy for the decision-making process. However, we do need to take into consideration depreciation and accrual item, not because we're on an accrual concept for our decision-making process, but because the depreciation is going to have a tax impact, which is a cash-related item. So we will have to determine, of the cash flows we put down up front, how much of them will be depreciable, what will be the impact of tax depreciation, what will be the impact of the cash flow to help us with our decision process. A couple more complex type of components in this practice problem as well. So we have the investment, we're putting money, and we're imagining to put money in both land and equipment of the 350. Now, land is something that's not typically depreciable, so we don't have the depreciation kind of impact and the related tax impact of it. The equipment then typically would be. Remember, we're talking about tax depreciation because we're really concerned from a cash basis perspective what the tax impact would be. So we're saying of the $350,000 we put down, the $300,000 of it is for 5-year MACRS type of asset, meaning we're going to use that 5-year MACRS depreciation schedule. That's going to be the tax depreciation that we will assume to be using here. We also have a residual value of the land of the $50,000. The $50,000 is going to be the amount that we put in the land, and we're going to expect that we could sell the land at the end of the time period, resulting in the $50,000 inflow. And so we're going to have the inflow of the $50,000 at the end of the project we are imagining here. Now, we bought it for $50,000. We're just going to say we sell it for $50,000, so we're not going to have a tax impact on that transaction at the end, but we will have a cash flow impact at the end. We have the security deposit cash flow year one, meaning we're going to put in another $54,000, which we're going to say is like working capital, or you could think of it kind of as a security deposit that we'll put down. We expect to receive that back in the future, and so that's going to be a cash flow out up front. We're going to say that we expect to receive at the end $34,000 of that $54,000. That then will be an added cash flow that comes in at the end that we'll have to consider our time value of money for, because even though we're going to get the money back, there is still, of course, that time period for which we don't have it, and that means we couldn't put it to work during that time flow. We had to put it somewhere else. We need to take that into consideration. We expect that this project then, or this investment, will result in either, you could think about them as savings or added inflows of the following for the next 6 years. Year 1, $100,000, 2, $230,000, 3, $120,000, year 4, $90,000, year 5, $60,000, year 6, $40,000. Tax rate, we're going to say, is 35%. Cost of capital is going to be the 12%. So we're going to have to think about this transaction. First, we're going to think about the amount of the depreciation, so we can consider then the tax impact of the cash flows. Remember that depreciation can be quite complex and can change from year to year. You can look at publication 946, which you can find on the IRS website. Go to the irs.gov, irs.gov, publication 946. Look that up. We're down here in table A1, and we're looking into the 5-year MACRS depreciation. Now we can see that we have the rates here that we could apply to the cost to consider the depreciation based on this information, And we can also then recalculate it. I'm going to estimate the calculation so we get an idea of what the depreciation actually is as it compares to like traditional straight line depreciation. It's going to be double declining in essence and half year convention in essence, although we see a deviation a little bit as it smooths out the last couple of years. So a little bit of an adjustment to it. So let's do that calculation here so we get an idea of what the depreciation schedule is doing. Remember, again, depreciation could change from year to year. So you got to make sure that you're picking up whatever the current law is and projecting out or thinking about what kind of changes that they might put in place with related to depreciation. So we have the cost. It's going to be the $300,000. We're going to say the number of years is 5 years. Straight line depreciation, then, if we were just going to think about it on a dollar amount basis, would then be the $300,000 divided by the $60,000, or I'm sorry, that would be 5, or the $300,000 divided by 5, which would be the $60,000. And then if we compare that to the cost, dividing by the cost, $300,000, we could get the rate, which would be 0.2, or the 20%, 20% on the rate. We can also get there by taking 1 divided by the number of years, which is 5, which would be 20%. That would be the straight line rate. Double declining rate would take that and multiply it times 2 to get the double and the double declining. That's the double and the double D. So the double declining percent then being the 40% or 0.4. If we take that and multiply it times the cost of the $300,000, we would get the double declining depreciation for year 1 of $120,000, but the MACRS has a half year convention. So typically we take that and divide it by 2, imagining that we purchased this thing in the middle of the year, even if we purchased it in January 1st or December 31st or any other time in the year. That's the general convention for taxes. Could be exceptions, but general convention. Divided by 2, 60,000. Remember, that looks like a straight line method, and it's the same amount, but it's not a straight line method. It's double declining half year convention. That's important because if you go to year 2 and use straight line, it'll be wrong. Year 2, we're going to take that same 40% times the depreciated cost, which I'll say is the $300,000 cost minus the depreciation. So far, accumulated depreciation or depreciation at this point would be the 240 times the 0.4 or 40%. We're looking at the 96,000. There is no half year convention in year 2. Moving on then to year number 3, we've got the 40% times the 144 calculated as the last kind of book value or depreciated cost minus the depreciation of the 96. That gives us the 144,000 times the rate, double declining 0.4. That gives us our 57.6. Then if we go to year number 3, we're going to take where we were at, the depreciated cost of 144,000 minus the 86,400, and I'm sorry, minus not the 86,400, minus the 57.6 gives us the 86,400 times the 40% times the 0.4 is the 34,560. Then, and we're going to take then the 86,400 depreciated cost minus the 34,560. And here's where we deviate a little bit. Instead of taking 40%, which would be the double declining method, it evens out a little bit on the code. So we'll kind of mirror this with our calculations by taking the same amount of depreciation here. That matches, you can see here where they have this kind of evening out of the 11.52. So once again, we're talking in terms of the calculation for depreciation, double declining half year convention, and then they got this kind of smoothing effect on the tail end sometimes as well. So there it is. We got the 34,560. And then in the last period, we would then take where we left off, the 51,840 minus the 34,560 gives us the plug of the 17,280. If we add up the bottom line, we should get back to the cost of the 300,000. Let's check it out. 60,000 plus the 96,000 plus the 57.6 plus the 34,560 plus the 34,560 plus the 17280 gives us our 300,000. So it will then be fully depreciated on the MACRS tax basis approximately here after the 6 years. Okay, next up in our process is to take a look at the cash flow then, so that we can then think about the tax impact on the cash flow and take that into consideration as well. So cash flow, and this is what we'll apply our present valuation on. We're going to take our earnings before depreciation and taxes, which is what we expect our benefit to be from this transaction, from what we're expecting to do here, which is the 100 for year 1, the 230 for year 2, the 120 for year 3, the 90 for year 4, the 60 for year 5, and the 40 for year 6. We'll just line them out in a horizontal fashion for years 1 through 6. Then we're going to apply the depreciation that we calculated in the prior method, or in the prior portion here, not because we want to be on an accrual basis, because remember, we're imagining we've already put the money down up front, or would, and this is allocating the cost. The only reason we're doing that is for the tax impact. So we're going to go up top and we're looking at the depreciation that we just calculated for years 1 through 6, putting that on down below for our depreciation on a tax basis, remember, then subtracting out here, so the 100,000 minus the 60,000 is 40,000, 230,000 minus the 96,000 is 134,000, the 120,000 minus the 57,000 is 60,000, and so on. That gives us our earnings before taxes. We can then apply the tax rate, 35%. Remember that the 35% in essence might be the marginal rate, like the end rate, because we're thinking about this decision at this point in time. So whatever our last tax bracket is, because we have multiple tax brackets possibly given a progressive tax system, would be the one that we might be applying in this case, as opposed to like an average tax rate. So if we then calculate this, the 40,000 times the 0.35, for example, 14,000. If we take the 134,000 times the 0.35, we get the 46.9, and so on, all the way across till year 6. Then we have the earnings after taxes, which is simply subtracting out, for example, the 40,000 earnings before taxes minus the amount that the government is going to relieve us from, is the 26, and then we're going to take the 134,000 minus the 46.9, and so on and so forth. So that's the earnings after the taxes. And then we're going to take the depreciation, we're going to add that back in, because the depreciation is not a cash flow item. We only took it into consideration to calculate the taxes. So we take that depreciation column up top, we simply add it back in. So now we've got the 26,000 plus the 60,000 is the 86,000, the 96,000 and the 87,100 is the 183,100, the 40,560 and the 57,600 is the 98,160, and so on. Now we also had those added cash flow kind of complications here, in that we had the sale of asset at the project end. So we're imagining, in other words, that we're going to sell this portion, which we're going to imagine is the land, and get basically that part of our initial investment back at the end. That's the 50,000. So we're imagining that's an inflow that's going to happen at the end of the process here. The cost is the same, so we're going to imagine there's no tax impact. Receive deposit at the end of the project. So remember, we're going to have to put in another 54,000, which we're thinking is a deposit or working capital we expect to get back, but we're only going to imagine here that we get back 34,000 of it at the end once again. So that would be an inflow at the end of the 34,000. These two amounts here, that 50,000 is included in the initial investment that we're going to put down for the land and the fixed asset that's depreciable, and the 54,000 is going to be included in the outflow that's going to be at the front of this project as well. So the inflows we're going to have at the end here. So if we add that up, we got the 17. We've got then earnings after taxes of the 14,768 plus the 17,280. And then we're going to add in the 50,000 to the 34. Let's calculate that just to make sure that I said that correctly. 14,768 plus the 17,280 plus the 50,000 plus the 34,000, and there we get that. Note that we should not have probably put an underline right here. That's a little deceiving. So because that 50,000 isn't the sum, you're adding up those four numbers. All right. So then if we go on down, so now we're going to say, let's do our net present value calculations now, because now what we have up top is in essence our cash flow. And you can see that even if it gets somewhat complex, you can just basically figure out what you think your future cash flows will be. And once you have them laid out on a year by year, you can then just simply apply your net present value as we've seen in prior presentations. However, note that there is a limitation here, in that if you're talking about cash flows that are happening during the year, when we do our present value calculations, we kind of assume that all the cash flow happened at the end of the year. That's one of the limitations of the present value method. You just got to kind of keep that in mind, but it is what it is. That's the tool we got, right? So we're going to go on down and do our present value. We'll do it horizontally and vertically just so we can see it both ways. We're going to take our cash flow, which is just mirroring the cash flow that we just calculated up top. I'm going to put my years up top so that if I was to calculate this in Excel, I can then use that to make my formulas much easier. The first one we're going to say then is this 86,000, which we're going to discount at the cost of capital 12%. Remember that cost of capital could be called the required rate of return, the hurdle rate, the discount rate. They might call it different things, but that's going to be what we're using, and it includes in it what we expect our return to be. Therefore, if we come up to this at the end with a 0 or above, that means we cleared the 12% and may take on the project. So that's included in there. So we've got that at the 12%. Also note that we're not showing the outflow yet. That'll be the next step we'll do, the outflow at period 0. So we're just looking at the inflows right now, discounting them back. The 86,000 then discounted at the 12% for 1 year out would be the 76,786. The calculation is down below. Note that if you want to calculate this using other methods than Excel, including a formula or tables, look at the prior section where we go over that in detail. If you're doing a problem like this where you have multiple periods and it's quite complex, it would be very tedious for someone to take away your financial calculator at least, or Excel to do that, because it would take a lot of math to basically recalculate each of these items. But if you want to know how to do that, take a look at the prior section. In Excel, it would look something like this. Negative present value, the rate is going to be an absolute reference. You can see by the dollar signs, we're picking up that 12% there. And then comma, number of periods would be 1, which you could see we're picking up with a cell reference, which is going to be that period 1 up top. That allows us to move it and copy it across. And then comma, comma, we got the future value. It's 2 commas because it's not an annuity, but present value of 1. And that then would be the 86,000, the future value. So then if we copy that formula across, here from here to here, the 183,100 discounted 2 years back at the rate of 12% would be 145,966. If we look at the formula, negative present value, the rate, same cell you can see because it's an absolute reference. That would be the 12% being referenced. Comma, number of periods is now 2. You can see we didn't type 2 in or hard code it, but instead used the 2 up top in a cell reference moving from M12 to N12, allowing us to copy it across, comma, comma. Future value is going to then be that 183,100, which is a cell reference here, moving across as well from M13 to N13. So if we then copy that across, then we have year 3, the 98,160, which is going to be discounted 3 years back at the 12%, is the 69,868. The 70,596 discounted at 12% 4 years back is the 44,865. The 51,96 discounted at 12% 5 years back, 28,993. And then the 116,48 discounted at the 12% 6 years back is the 58,794. Adding these all up, we get the present value of the 425,272. Comparing that then to the outflow that happened at period 0, which is the 404,000, which is a little tricky because that includes both the amount that we put up top for the equipment and land, 350,000, plus this 54,000, which is the working capital, or kind of like the deposit we were expecting to get back, at least in part, the 34, and that's going to give us our 404,000 that we put down up front. So that's what we put down, the 425,272 minus the 404,000, and this one doesn't need to be discounted, the 404, because it happened at period 0. That gives us the 21,272. This 21,272 is the net present value at 12%. It's greater than 0. Anything 0 and above means we cleared the rate of the 12% and therefore may take on the project. Now, if you were to take this table and just make it vertical fashion, it would look like this. This is how we've seen it in prior presentations as well. Some people may prefer to see it this way. From 0 this time, period 0 up top, to period 6, we do our same kind of cash flow. This time we're going to put the 404 up top in a negative number representing the outflow. And then we'll have our same cash flows simply in a vertical format, the 86 to 183.1, the 98.160, and so on. I'm going to do the present value to the 404 at period 0 this time, even though it comes out to the same number, so that we have a uniform set of columns in the outside and could then copy them down easily. That would be the negative present value of the rate, which once again, 12%. You can see that's an absolute reference here with the dollar signs allowing us to copy it down as there is something outside of our table. When we take that something outside of the table, we typically need to make it an absolute reference or a mixed reference, but absolute. Comma, number of periods is going to be 0. Instead of hard coding the 0, we took the 0 from the cell over here because that allows us to copy it down. That one then will move down relative and pick up the proper number, and then comma, comma, future value is the 404. That one also allowing us to move down in the cell reference of V2. So then if we looked at the second one, we got the 86,000 present valued back 1 period, 1 year at the 12%, gives us the 76,786. Formula, negative present value, and then brackets the rate, the 12%. You can see it's the same cell here because it's an absolute reference, comma. Number of periods is then 1. Moving down here, you can see that moved down with the cell reference going from U2 to U3, comma, comma. And then we have the future value, which of course is the 86,000. And that then you can see it moved down from the cell reference V2 to V3, moving down relative. If you continue this on down, we got the 183,100 discounted back 2 years, 12%, 145,966. The 98,160 discounted 3 years at 12%, 69,868. The 70,596 discounted back 4 years, 12%, 44,865. The 51,96 discounted 5 years, 12%, 28,993. The 11648 discounted 6 years at 12%, the 58,794 for a total of that 21,272. Now that cleared once again the 12%. Anything above 0 would indicate that that is indeed the case. You might ask, what is the rate there? To calculate that, that would be the internal rate of return. The internal rate of return being the rate at which, if we used it to calculate the net present value, would result in 0. And so that then is going to be calculated as equals the IRR, summing up the values, negative numbers for the outflow, positive for the inflow, and that would then result in the 13.98. So we can think about this. After this full thing, we say, okay, is the net present value above 0? If yes, then we might take it on. We're going to say, yeah, it was above 0 because that means we cleared the 12%. So then we might say, well, what was the actual internal rate of return then? If we know it's above 12%, the higher the number, typically the better here. But what was it on a percentage basis on the IRR, internal rate of return? In other words, what rate would be one which this series of cash flows would result in 0? That would be the 13.98.